All right, Doug, time to bring you in. I'm dying to hear what you have to talk to us about, and I know our viewers are as well. So, you ready to go?
I'm ready.
All right, let's do this.
All right, so let me just share the screen here.
I'll be taking your questions in the chat room, guys, so feel free to put those in there, and we'll see if we can get to them at the end of the presentation.
Okay, well, first of all, thanks for having me, guys. It's I really appreciate the opportunity to speak with your people. My name is Doug Busch, as I was introduced before. Just to give you a little background about myself and what I do. I'm a CMT, a chartered market technician. I'm the founder of ChartSmarter.com. It's a service dedicated to technical analysis. Each day I write a report on a major specific S&P sector. In each report, there are usually 4 to 5 high conviction ideas, depending on the group I'm profiling that day. I consider myself a swing position trader with a longer term time frame. You can actually call me, I love the phrase, the cocktail napkin technician. I try and keep it real simple with a pure focus on price action and closing prices. I'm a big fan of the round number theory. There'll be a few examples of that. Gap fills as well, triangles, bullish and bearish, head and shoulder patterns, and I love the candlesticks. I think that gives me a little bit of an edge since not too many people really focus on them. All right, with that being said, I would like to present 4 themes today that I think can make you money, 3 bullish and 1 bearish. Okay, so as you see here on the screen, my first bullish theme is the semiconductors. They have been surging. I have a little ratio chart here comparing the SMH, the semiconductor ETF, to the NASDAQ. The group seems to have their groove back. They were playing second fiddle to software for a few months there, but the semis, they're beginning to carry the NASDAQ on its back. I know today we're down a little bit, but let's see how we finish out. Perhaps the semis are giving the software some time to rest before they reclaim their top leadership spot. But either way, I think it's a good sign for the overall market. You see the uptrend here on the ratio chart. It's pretty obvious. If you remember, semiconductors last year were one of the first groups to fall apart, and they were never really able to regain their momentum. But that's starting to change. All right, just below here, I have the ratio chart comparing the semiconductors to software. These are 2 of the best performing subsectors within technology. Of course, services is doing very well with Apple, but this ratio chart is comparing the semis to the software. The jury's still out, but this recent strength within the chips is definitely a positive development, in my opinion. Just a couple of months ago, I mean, if you really look back, there wasn't really much to like in the semiconductor space. Xilinx, of course, has been an outlier, a beautiful chart, still is. But there's been some nice moves by stocks like Cree. Like I said, I'm a big proponent of the round number theory. It was stopped at the 60 number. Might be looking to retest the cup base breakout trigger of 5188. Lamb, LSCC looks good in the space as well. But if you take a look here at the ratio chart, you can see this sideways channel. You saw this big move up in late January, and it's seeming to trade sideways here. After it broke that downtrend, it is holding it. It's still in the middle here. I'd wait for a breakout for real confirmation. But the semis as a whole, they are starting to look good here. All right, just below here, I have a perf chart. I like this. I use it a lot on stock charts. It's just an illustration of the bifurcated nature that exists in all subsectors. You can see the outperformance. If you look at these old tech plays, Xilinx and AMD have really outperformed. Micron and NVIDIA, not so much so, although they might start to do their thing. What is this chart really telling us? This is a space you really want to deploy your capital to. It's just starting to outperform again. And we know that trends, once they begin, they're more likely to persist than reverse. All right, so with each theme, I have three of my favorite ideas. Let's get into my favorite idea right here. KLA 10 core. CLAC is the symbol. It's an old tech semi player, higher by 33% and 10% over the last 1 year period. It has a decent dividend yield of 2.5%. For the guys that, you know, like the fundamentals, it's had 5 consecutive positive earning reactions. It's higher 11 of the last 13 weeks, and it's now 5% off most recent all-time highs recorded this week. Keep in mind, all these charts are from about 10:30. I know we've seen a little sell-off, but these charts are all from earlier. The prices could be changing. You see on the RSI, for a good portion of February and March, it wasn't shying away at all from the, you know, above 70 overbought RSI number. Had a bullish inside day last Friday on light volume. It did break above a bull flag here. It's about to retest that now. You can also interpret this as a cup with handle breakout. It's still in the same spot. It's retesting this breakout. It's not uncommon at all for breakouts to be retested to test their volatility. I like the way that this chart trades very tight. You know, bearish names, bearish characteristics, they trade very wide and loose. Now, on the bottom of each chart here, you'll see I like to compare the actual individual name to the group itself. So there's a ratio chart here between CLAC and the semiconductors, and you can just see higher lows making a nice uptrend. Kind of looks like a bull flag here on the ratio chart as well. And here, for those of you old enough to remember CLAC and AMAT, they used to be the 2 monsters in the group. But this ratio chart is showing you just this very nice outperformance in KLA compared to AMAT. Like I said, CLAC is about 5% off its most recent all-time highs. AMAT is down by more than a third. Very small dividend yield on AMAT as well. But you can see the sideways trade on the ratio chart between October and February. And then it just took off. And it looks like a bull flag on the ratio chart here. Continuation pattern. Look for this outperformance from CLAC to continue against AMAT. All right, my second name within semiconductors, analog devices. This name having a nice year as well, up 23%, up 16% over the last 1 year period, dividend yield of 2%. This one also, nice earning reaction history, 4 consecutive beats, or 4 consecutive positive reactions, if you will. It's up 11 of the last 13 weeks. And like I said, I'm a big proponent of the round number theory. You can see here on the chart, it was held back at 100 last June and last August. And once it burst above, I'm looking for this 100 number, form of resistance to become support. Again, this number is pulling back into this. It recently recorded a break above a 103.69 cut base pattern. It was 8 months long. The longer the base, the greater the space. But I think going forward, this 100 number, the round par number, will now act as support. You see on the bottom here, this ratio chart, analog devices wasn't doing that well compared to the group in 2017, but that changed in 2018, and it's testing the cut base right here. I think higher prices are ahead. As long as it stays above 100, I'm really positive on this name. All right, my third and last play within the semiconductors is Microchip. It's higher by 15% year to date, lower by 12% over the last 1 year period. Decent dividend yield of 1.7%. It's in bear market territory. It's down about 21% from its most recent highs. It's lower for the last 5 weeks, but you know, it had a nice move, 29% combined move during a 6-week winning streak to begin the year. This one has back-to-back positive earnings reactions to inspire a little bit of confidence, make you think things are back on the right track. You can see the move above the bullish ascending triangle. Again, round number theory was held back at 80, right back in the beginning of December, was held back again there in January. It broke above that. You can see actually the 60 number in late October was support within the ascending triangle. So if you measure the width of the triangle, 80 and 60, that's 20 handles. It has a measured move to 100 again. You can see in here, it was actually stopped at the round 90 number, not surprising. It's filling in this gap again from the 2-5 session. And let's see, it's as of right now, like I said, these were prices at about 10:30. It's below the 50-day. Let's see if this 200-day moving average holds up. Again, on the bottom here, we have microchip against the semiconductors. You can see, you know, it has underperformed since February. Like I said, it's down 21% from its most recent highs. But it might be coming into, you know, maybe a triple bottom here. You know, I think this offers good risk reward with a tight stop. All right, let's look to my second positive theme here, energy. As you can see, I have the ratio chart here of the XLE, the energy ETF, over the SPX, the S&P 500. I like how it's taken its time here. Obviously, you can see that steep downtrend compared to the market from October to December. It's starting to bottom out. Bottoms take time. I like that. Just the opposite is tops are, you know, in a more crazy fashion. This group has been in the penalty box, as you see. For the last 5 years, it's been the worst or second worst performer of the major S&P sectors. It's paid its dues. I think we can look for potentially higher prices. We'll take a look at crude here. Again, I'm a round number guy. The 60 number, this is obviously yesterday's closing prices, but it looks like 4 out of the last 5 days we're just flirting with this 60 number. It's being held back there. Markets have been taking their cue from crude, remember. Oil and markets bottomed together on Christmas Eve. The energy equities, you know, it could be a tailwind, this stronger crude price. Some of them are acting well, some are acting better than others. We'll get into that. But you can see here on WTI, we had a nice bullish inverse head and shoulders pattern, broke out, was retested a couple times, which morphed into a bull flag. And now it's going up again. I like the way this is shaping up here. I think once it gets above 60, I think it can get above the 200-day moving average pretty quickly. There's been a lot of bad news about it, about oil, but it seems to be shrugging it off. That's very positive action. All right, so let's get into my 3 favorite energy plays. All right, British Petroleum, integrated energy giant. We're all aware of it. Higher by 16% year to date, 13% over the last 1 year period. Big dividend yield, 5.6%. It's had 4 consecutive positive earning reactions as well. Not huge moves, but you're not going to see huge moves from a big super tanker stock like this anyway. But still, give it credit. 4 straight positive reactions. It's had good digestion with that break above the 200-day moving average for the whole month of February. It kind of flirted with trying to go back beneath it, but bulls held it. We had a golden cross last week. I think you can enter here with a retest of this bull flag breakout from 313. You can see it's right here. It needs to hold here to not break that series of higher highs and higher lows on the RSI. Again, I'm a big price guy. Price overrules everything. The bull flag breakout on the 13th of March. Keep in mind, it rose more than 3% on double average daily volume. I really like volume on breakouts. The breakout carries a measured move to 47. It's been digesting the move nicely here. You can see the volume trends. Again, on the bottom here, I'm comparing British Petroleum to the energy ETF. Nice smooth uptrend on this ratio chart. Now let's take a look, just a quick look at its weekly chart. Okay, obviously I'm a longer term guy. I like to take weekly peaks as well. The weekly chart here shows, you know, if it can get its act together, it's well off this double bottom, potential double bottom here of 47.26. But just keep in mind, as technicians, you know, we believe the best stocks give you the opportunities to add on the way up. If it can get its mojo back and break above this double bottom pivot, it would negate this potential triple top. But you can see here, it's up 11 of the last 13 weeks. 2 weeks, there were 2 doji candles. Last week, of course, the gravestone doji candle. As we know, dojis are often pretty good in predicting fatigue from the prevailing trend. It almost moved up 10 points from those December highs. So you might see some digestion here. Remember, on the daily, I like it here. If it can get above 47.26 on the weekly, that's a breakout above a double bottom pattern. Okay, next we have Valero. All right, this is a refiner, obviously. Higher by 16% year to date, down 6% over the last 1 year period. Nice dividend yield, 4.1%. This one, you know, earnings as well, acting pretty good. 3 of the last 4 were higher. Obviously, it's down a third from its 52-week highs. It's underperforming peers PSX and OXY, which are down about 23%. But I think actually that's not right. It's the bullish inverse head and shoulders pattern. It was a break above 83 on the 31st of January. Carries a measured move to 98. Again, this, you can see the sideways trade. I really respect this. I think it's I think the bottoming process is well underway, and I think you're going to see higher highs. And if you look down with VLO compared to the XLE here, we know false moves usually have very strong moves to the opposite direction. If you look, it looks to be breaking above a rounding top here on the ratio chart. So keep an eye on this one. Nice dividend yield, still well off its highs, has room to run. All right, next we have Warrior Coal. Obviously not a traditional energy play, but this name enjoying a really nice year. Up 25% year to date, lower by 6% over the last 1 year period. Dividend yield, not a great dividend yield, 0.7%. But what I really like about this name, you can see the digestion had a huge move of well over 300% between June of 17 and June of 18, and it's traded sideways ever since. Again, I'm a big proponent of round number theory. You can see the weeks ending 2/22, 10/19. That should be an 18 and 6/8/18. We're all above 30 intra week, but 0 were able to close above them. You can see the reversals there. It's actually up nicely today. Of course, this is a weekly chart, so I really want to see this close above 30. Obviously, like I just mentioned, 3 other times it was well above 30 as well, but failed. But nice support recently at the rising 50-day on the weekly chart. And I think you can add to this above a 30.67 double bottom with handle pivot. Remember, this is the longer chart, longer the space. Longer the base, the greater the space. Again, let's take a look here at Warrior compared to the XLE. Actually, a better comparison would be right here below against the coal ETF, KOL. Keep in mind, KOL is pretty liquid. I think it trades about 25,000 shares a day. So, but the instrument, it does give you a good idea of what's going on within the industry. If you take a look at the ratio chart here, it shows HCC strongly outperforming the coal. HCC is just now 4% off its recent 52-week highs. KOL is 23% off its own recent highs. Peer, of course, we know Peabody now 37% off recent 52-week highs. That looks like it's going lower. It's weighing on coal. All right, my third positive theme, staples. Under the radar, we have our staples, the XLP, the Consumer Staples ETF, comparing it to the S&P 500 here. As you can see, there was some strong gains in October against the S&P as investors, became more defensive. The ratio chart ended up giving it back about half of those gains. Looks well rested here. It looks like it's turning up again. Let's keep an eye on that. It's higher 10 of the last 13 weeks. Now trades just 2% off most recent 52-week highs. We'll take a peek at the year-to-date performance below, but on a one-month look-back period, it's just 1 of 5 of the major 11 S&P sectors higher by more than 1%. So anticipate this group to hold up well on a relative basis, not necessarily an absolute basis. Well, it could absolute as well, but if these markets return to their volatile ways, I think investors will return to these names. All right, year-to-date performance, as you can see, still up over 10%. Again, this is around 10:30 prices this morning, but you can see all the 11 major S&P sectors here. Technology, obviously, it's a good sign overall. up almost 19%. But again, you're getting capital appreciation here. You get a nice dividend yield of 2.8%. It's only outperforming the materials, financials, and healthcare. But again, every sector is up so far year to date. Very good showing. All right, let's get into my favorite 3 staple buy ideas. Number 1, Hormel, Spam. Food products play. It's higher by 4% year to date, 32% over the last 1 year period. Decent dividend yield of 1.9%. Acting anything but defensive, of course, as we said, it's just 4%. And these are recent all-time highs. It's behaving much better than their peers. Conagra, which actually had a decent earnings report, I believe. Kellogg's, Campbell's, all down. You can see well into correction toward a bear market territory. I don't have to tell anybody what happened to Kraft Heinz recently, but some of these staple plays, if you really look, you can find some gems. On the bottom here on the ratio chart, you see Hormel against the staples. It looks like it's rounding out a bottom pattern and looking higher. On its daily chart here, you can see the 44 number was resistance a couple of times. And the bottom upward sloping line within the triangle found support a few times. Finally broke above 44. That's your trigger in a bullish ascending triangle. And you can add to this above a cup-based trigger, you can see which engulfs the pattern above a 46.36 close. I like the space between the 50 and 200-day moving averages with both sloping higher again. All right, my second favorite staple idea. General Mills, nice breakout. I mean, this looks like a tech stock. Staple name showing great strength, up 33% year to date. Beautiful dividend yield, 3.8%. Last week, it rose almost 7%. It's higher by another 1.7% this week so far, showing great follow-through. Very stubborn, not giving back any of that lofty gain last week. And this has produced 2 straight nice earnings reactions as well. Again, round number theory guy, powerful close above the 50 number sets the stage for the move to the 60 figure, which was resistance back in late 2017 and early 2018. We like to see, most breakouts, most obviously good breakouts, the best ones work out right away. You want to see good action post-breakout. This, you can see, did just that, above a 45.10 trigger on February 19th, digested the move very nicely, then burst above a little short consolidation this week, demonstrating excellent relative strength. Look at the volume. Very nice volume here. I think you can enter this on a pullback around 51. All right, you see down here again on the ratio chart, comparing the individual name, General Mills, to the staples. Nice, smooth uptrend. All right, my last staple idea, a Mexican play, Fomento, Económico Mexicano. It's a beverage play. It's higher by 7% year to date, 3% over the last 1 year period. Slow mover. Dividend yield of 1.5%. Last week it was higher by 2.7% as the S&P fell 0.7%. Good relative strength. Nice action. It's been trading between the round numbers again of 80 and 100 for the last 14 months. I think this gets pulled magnetically toward the round par number. Last Friday ended a 5-session winning streak, closing the upper half of the daily range on that ugly tape that we encountered, which also found support at its 50 and 200-day moving averages. I think you can enter here as it finds support against those averages again. And again, the best stocks are going to give you a chance to add on the way up. You can add to through a double bottom trigger of 93.85. Notice here, steep downtrend was broken nicely, held right here. This is actually a bullish Morningstar pattern with its spinning top candle in between. This bearish engulfing candle had no follow through to the downside. Decent sign. Again, here on the relative strength chart, you see Fomento, downward channel here, broke above it, but now it's testing this here. Let's see if it could, you know, kind of move higher out of that little downtrend range there. All right, my last theme here is my bearish one. It's on the financials. Obviously, we know there's been a lot of talk about the inverted yield curve, but this group has been it's been weak for some time. We take a look here at the XLF, the major financial ETF, trades 12% off its most recent 52-week high. Last week, terrible week, fell almost 5%. By far the worst showing of any of the major 11 S&P sectors, I believe. Yeah, the materials were down just 2%. So there's a lot of space between 10 and 11. On a year-to-date basis, it's just ahead of healthcare, up about 8%. And again, big proponent of closing prices as well. This chart shows the importance of that. And keep in mind, the best breakouts work right away. This group was never able to touch. It came close, but not touching the overbought 70 RSI number in the last 6 months. Shows you it's been a laggard. And here again, we had a bullish inverse head and shoulders breakout above 27 on the 18th of March, reversed hard that day, forming a bearish dark cloud cover candle. Obviously, that showed some follow through to the downside. And notice the accelerating volume last week between Tuesday and Friday. Volume grew with each day as it fell. You can make a case here, spinning top candle. I mean, I wouldn't call that a Morningstar pattern, but this is a group here that, to me, it's got investors' hopes up so many times, and just as it looked like it wanted to break out, got hit back down again. Let's take a quick look at the ratio chart comparing this. The XLF to the S&P 500. I mean, if you turn this chart upside down, it would look unbelievable. We talked about the inversion on a 1-month look-back period. It's the worst performing major S&P sector. And on a 3- and 6-month look-back period, it's the second worst actor. Classic chart here. You can look at this as the staircase up, bloom, 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 elevator down, bloom, elevator down. All right, quickly here. I know I'm running out of time. Let me look at my favorite 3 financial sell ideas, interactive brokers. This was a leader. It shows you not to fall in love with names. They can turn very quickly. But this name is now lower, 7% year to date. Obviously, we know the market's had a nice rip. And it's low at 24% over the last 1-year period. It had that huge move, as you can see here. Rose 43 of 56 weeks, very consistent, nice tight trade. Look to the right of it, you see kind of volatile bearish trade. It's been down 27 of the last 43 weeks. Now trades almost 40% off most recent 52-week highs. Just any stock that hasn't participated in this big move since Christmas Eve, that's a red flag. Big caution there. You can see here on the weekly RSI, continually hit right at the 50 number. You got a symmetrical triangle here. You could short this with a sell stop below 49. As a measured move to 33, you get that from measuring the 16 handles in the width within the triangle. Very hard to underperform on a lagging group, but this is exactly what this stock is doing. Lower highs. All right, my second name, Jefferies, up 6% year to date. Lower by 17% over the last 1-year period. Decent dividend yield, 2.7%. Has not recorded back-to-back weekly gains since mid-January, as the market has been ripping. Breakdown occurred the week ending, October 12th of last year, fell 9% in the strongest volume in the last 11 months. The break was retested multiple times and held. You can see slightly downward sloping neckline, not that uncommon. Broke down below it, tested it again, tested it. It really looks like it's fallen off here. I mean, it's hard to short here. I would wait for a little bit of a snapback rally, maybe around 1950. But again, as you look here on the ratio chart, very poor showing here on the ratio chart, making lower lows for years now. All right, my last name, the exchange plays, CME. Down 13% year to date, higher by just 3%. Over the last 1-year period. Dividend yield of 1.8%. Down 6 of the last 7 weeks, and now is down 15 of the last 17 sessions. Could make it 16 of 18. This one, we spoke about some of the semis that had very good history of earnings reactions. This one's just the opposite. 4 consecutive negative reactions. And you can see here, I mean, it broke below. It's been above this rising 50 weekly day for a long time. Finally broke below it. As I said, most breakouts or breakdowns are commonly retested. I would wait for a move back into 166 to short this. Again, 2 recent 3-week losing streaks right here. Again, the last 3 weeks prior to that, there were just 2 times that it did that in the last 2 years. So pretty significant. On the ratio chart here on the bottom, you can see a bearish head and shoulders here, broke down and is continuing to the downside. So that's my report today. Any questions or?
Yes, actually there is. First of all, great presentation.
Thank you so much.
Yep, really enjoyed it, Doug. And I loved you talking about the candlesticks because I'm a huge candlestick fan. So
love it.
Yeah, you had my attention there. I follow the candlesticks pretty closely. There was one question in the room, and actually they asked about 2 stocks, but I'm going to give you one of them because the other one is a little bit lower liquidity. And I didn't think it looked as good technically. But this other one's a small one. It's NOG. So the question was, what do you think of small energy companies? And let's use NOG as an example. What do you see here?
I mean, look, I'll be totally honest with you. I very rarely follow stocks under $5. Just looking at it from a pure price project, I mean, it's kind of caught here between the 50 and 200 day. I would be more positive. I could see this above 3. Looks like it's bottoming. I mean, like I said, the energy group I'm kind of positive on. But, yeah, this is a play. For me to be bullish on this, I need to see it over $3.
Okay. It's funny because this is one I think that I included yesterday on a segment that we did called Under the Radar. And this was one that I actually picked out of the energy space. And the reason I did is I kind of like that volume that's come in here over the past 2 or 3 weeks to the upside. All of a sudden we've got
yeah.
There.
It does look strong.
All right, I got a question for you though.
Absolutely.
And I'm going to let you, maybe give this one some thought. I'll go ahead and show my screen. And all right, so this is a chart of the dollar. And I got to agree with you on the one hand about the crude oil prices going higher and the fact that's a, nice little driver for the energy stocks. However, energy and materials have both been battling this overhead or headwind in the form of the dollar. And so I've gone back the last 20 years and show the dollar declining during the last bull market, the one from 2002 to 2007. We had a declining dollar and energy and materials led that bull market rally. In this bull market, though, the dollar's been moving higher and both of these groups have been underperforming the S&P 500 as a result of a stronger dollar. So I've been torn, actually. When I look at energy stocks, I tend to walk away from them because of the headwinds of the dollar. So my question is, do you follow the dollar, and do you think that the crude oil prices rising will overcome the falling or the rising dollar, or what are your thoughts there?
It's hard to say. I mean, look, it's obviously a traditional intermarket relationship. The energy group, to me, it does sort of remind me a little bit of the financials. Every time it seems to get a little lift and you're getting a little bullish and you're feeling better, it just careens lower again. So it's probably a group I wouldn't trust. Yeah, I mean, look, the dollar does look good here. I like these ratio charts. But, as long as the price action within these energy names, if it can shrug that off, that's a very positive development for me. But, let's see what happens. But I agree with you wholeheartedly there.
Okay. Yeah. Now, and a lot of times when I look at a chart like this and I see the energy groups underperforming, but I like an individual stock, I usually preface it with the idea of, okay, I like this stock, but knowing that it's part of a group that's been underperforming, if it starts to fail, you don't want to sit there and make too many excuses for it.
Not at all. Not at all.
So we're
to go one bit further. I mean, there, I would tend to wait. I mean, if I'd keep it on a radar or a watch list, because once if that group does turn around, that name will probably one of the strongest first ones out of the gate if it did show good relative strength while the group was struggling. But I agree with you. All
right, fair enough. Well, we enjoyed having you today. We certainly would love to have you back sometime. Great presentation, Doug.
Thank you so much. Thank you guys for having me, and I'd come back anytime.
Hi, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. Today we're going to tell you all about relative rotation graphs. Here are the topics in the timeline for today. First, we'll talk a little bit about Julius de Kempenaar and his blog. We'll show you where you can access relative rotation graphs. Then we will go over the page setup of the RRG web page. We'll look at the two indicators that drive RRG, the RS ratio and RS momentum. We'll show you how the quadrants work on the RRG chart. And finally, we'll go over the RRG ranking table. Created by Julius de Kempenaar. There is a blog here by Julius de Kempenaar, and if you go up to the blogs tab at the top of any web page, you click on that tab, and on the right you have all Stock Charts blogs. And if you click on the RRG charts, you can find a little bit about Julius de Kempenaar, creator of RRG, and also read some of his analysis using RRG charts. You can also find detailed information on RRGs in the Chart School. We have a very detailed article there. In the Chart School, you can scroll down to the Indicators and Overlays section and find the article, or you can just go up to the search box, type RRG, and click the search icon. And the first link at the top will be the Chart School article on relative rotation graphs. Accessing RRGs. There are a number of places you can access RRGs. First, I'm on the free charts page, and over on the right-hand side you see charting tools, and there's a link for relative rotation graphs. Also, in the middle section, if you scroll down, you will see a link to launch the RRG chart. Furthermore, if you go to your members page, you will see links to access RRG charts in the Control Center under Charting Tools, RRG Charts. And if you scroll down to one of your chart lists, you can immediately put that into an RRG chart. So I click View As, and then I select RRG, and I will see all the charts in that chart list as an RRG chart. Furthermore, when you're in a viewing mode on a chart list, you can go to the top of the page and you can click the View As drop-down menu to select another viewing option, and RRG is of course one of those options. RRG page setup. Now note that free users do not have access to all the features available to members of StockCharts.com when using RRG charts. At the top of this chart, you can see the symbol list, and you can add or remove symbols separated by a comma. Then we have the benchmark, which we are using to compare those symbols to. There's a drop-down menu where you can change the group that you want to analyze. You can change the time frame, the period setting, and once you've made those changes, you can click Update to refresh that chart. In the middle part, we have the actual RRG chart itself with the RS momentum scale on the left and the RS ratio scale on the bottom. There is the slider where you can change the date range for the RRG, and you can see how the RRG moves when I click and drag. You can adjust the tail length to make it longer or shorter. Below the tail length setting, you can see other settings to animate the chart. You can enlarge the chart, or you can decrease the size of the chart. If the tail lengths exceed the chart area, you can fit the chart so that all the tails fit within that. You can also center the chart, and you can also maximize the chart. At the bottom of the page, you have the ranking table that shows the top sectors at the top and the bottom sectors, of course, at the bottom, and the benchmark. There's also a link for further instructions and a permalink if you want to share that chart. RS ratio and RS momentum. The RS ratio is based on the price relative. So I've got a chart here for Caterpillar. There's a bar chart in the top window. In the middle window, I've got the price relative. This is Caterpillar divided by the Dow Jones Industrial Average. It's a relative strength line. And when it rises, that means Caterpillar is outperforming the Dow Jones Industrial Average. The red line in the lower window is the RS ratio, and it fluctuates above and below 100. So when it moves above 100, that means this price relative is rising. When it moves below 100, there's been a little dip in the price relative, and when it moves back above 100, you're seeing relative strength again. This chart shows General Electric, and in the middle we have the price relative, the General Electric Dow ratio, and you can see that this ratio chart is declining. And so the RS ratio moved below 100 in May 2016 and has remained below 100 as this price relative moved lower, relative weakness. The green line is RS momentum, which also fluctuates above and below 100. This indicator measures the momentum of the RS ratio. So it is designed to anticipate upturns or downturns in the RS ratio, just like any other momentum indicator like MACD or rate of change. So you can see the RS momentum indicator started moving up, and then the RS ratio turned up. Similarly, the RS momentum indicator started moving down, and the RS ratio turned down. RRG quadrants. Now let's put it all together to see how this looks on the RRG chart. I've got an RRG for the Dow Industrials, the 30 stocks, and you can see the x-axis is the RS ratio axis with 100 as the line in the middle. So everything to the right of this line has a RS ratio that is above 100. In general, everything to the right is showing relative strength. Everything to the left is showing relative weakness. Then we have the RS momentum indicator on the left with the y-axis, and you can see 100 in the middle. So everything above is showing some improving momentum above 100. Everything below 100 is showing some deteriorating momentum. So when we put it all together, we have 4 quadrants. In the leading quadrant, you have the RS ratio above 100 and RS momentum above 100. In the weakening quadrant, the RS ratio is still above 100, but the RS momentum indicator has moved below 100. Then in the lagging quadrant, you have weakness in momentum and in the RS ratio because both are below 100. And in the improving quadrant, you have RS momentum moving above 100 and RS ratio still below 100. So the idealized rotation would be clockwise, where you go from leading to weakening to lagging to improving. And you can see Caterpillar is in the leading quadrant and General Electric is in the lagging quadrant. RRG tables. Just below the RRG chart, we have a really handy RRG table. And you can see the leaders at the top. All the ones in green are in the leading quadrant, and they are sorted by the tail length. And that means they have moved the furthest on the RRG chart. The blue is the improving quadrant, the yellow would be the weakening quadrant, and the red would be the lagging quadrant. And again, you can see General Electric in the lagging quadrant and Caterpillar in the leading quadrant. You can also sort by clicking the column headings if you want to sort by sector, name, or industry. That concludes this instructional video on RRGs. Thanks very much for tuning in, and be sure to check out our other instructional videos.